So here's the big question, the one everyone in finance and crypto is wrestling with. How do you actually bridge that gap, between crypto innovation and the regulated financial world?
Yeah, it's a huge challenge. Disruption is one thing, but integration, that's different.
Exactly. And today, we're doing a deep dive into a really interesting approach we've seen in the sources. It's the launch of 12 digital assets on MetalX lending, powered by the Loan Protocol.
Right.
Our mission, really, is to unpack how this works. How does this lending platform offer not just DeFi, but compliant DeFi? That's the key bit. And crucially, how does it all fit into Metallicus's bigger picture, this thing they call the Digital Banking Network, or TDBN?
Well, when you look at the details, it becomes pretty clear this isn't just, another DeFi protocol popping up.
Okay.
It feels much more like an infrastructure play, almost like a proof of concept, showing that blockchain tech, when built for compliance, can actually work with regulated finance.
So a blueprint for banks and credit unions, maybe, and for retail investors too.
Exactly. It's aiming for both, which is ambitious, showing scalability and regulatory certainty. That's the goal.
Okay, let's dive into that foundation then.
Yeah.
The 12 assets, the sources call this a diversified backbone. We're talking Bitcoin, Ethereum, Stellar, Litecoin, Cardano, Hedera.
Tether's in there too, Dogecoin, Metal DAO. It's a broad mix.
It really is. So why start with such a wide range? Why is that specific mix important?
Yeah, that diversity is absolutely essential. For you listening, understanding why goes right to the core of how this TDBN thing is supposed to scale.
Okay.
So first off, it's about liquidity depth. Simple as that. Any lending market, it needs deep, reliable pools of assets.
Right, so people can actually borrow and lend without moving the price too much.
Precisely.
No.
And by using multiple assets, maybe ones that don't always move together, they spread the risk. If Bitcoin has a crazy day, the whole system doesn't just fall over.
Okay, that makes sense.
Yeah.
Risk management 101 almost.
Yeah.
Building in buffers.
Exactly, spreading the exposure. The second big reason, it's institutional onboarding. Think about a bank or a credit union. Right.
They're not going to just suddenly offer like one niche token.
Yeah.
If they decide to step into digital assets, they need options. They need to cover what their customers might actually ask for.
So this list gives them that starting point, a kind of compliant sandbox to play in.
That's a good way to put it, a sandbox, yeah. It gives them the coverage they need to even begin exploring this space seriously.
Okay, but I have to push back a bit here. If the aim is building trust with, serious financial institutions, why Dogecoin?
Oh.
Doesn't including something so volatile, maybe seen as a meme coin, risk undermining that credibility they need?
That's a really fair question.
Yeah.
And it points to a balancing act they're doing.
Okay.
Including assets like Dogecoin. That speaks directly to the retail side we mentioned. TDBN isn't just for banks, right? It needs regular users too. Lots of them.
So driving volume and usage from the retail side.
Exactly. Popular assets bring in users, bring in volume, which helps keep lending rates competitive. The credibility, then, isn't supposed to come from every single asset on the list.
It comes from the rails, the compliance framework around those assets, which actually leads perfectly into the third point.
Which is?
Stablecoin integration. Think about those initial 12 assets, even the volatile ones. They all create deep pools of liquidity.
Okay.
And those pools are absolutely vital. Why? Because they're going to be the foundation, the backing for the next wave of stablecoins, the ones issued by the banks and credit unions themselves.
Ah, so the banks will issue their own stablecoins on this network.
That seems to be the plan outlined in the sources. These stablecoins are set to become the main settlement layer for TDBN, and to do that reliably, they need huge amounts of diverse collateral readily available. These initial assets provide that.
Got it. So the 12 assets are like the initial fuel, the collateral, to get the stablecoin engine running later.
You could think of it that way, yeah.
Okay, this is where it gets really interesting for me, the compliance angle. MetalX lending is described as being built for regulatory alignment from the ground up. That sounds, very different from a lot of early DeFi.
It's a night and day difference, really. That regulatory foundation is the whole point. For a bank to even touch decentralized lending, they have to know who they're dealing with. Identity is non-negotiable.
Right. KYCML. The big hurdles.
Exactly. Which brings us to the first design principle, KYC-enabled access.
How does that work in practice?
Users don't just connect an anonymous wallet. They interact through the Webauth.com integration.
Okay, so there's an identity layer right at the front door.
Yes. No, your customer isn't an afterthought. It's built into the access point. Now, that definitely limits the sort of pure anonymity some crypto purists like.
Sure.
But it provides the transparency and accountability needed for AML, for CFT. Basically, it makes the transactions legally trackable and understandable for regulators.
So decentralized markets, but with centralized, verified identity. Okay, but what about the user experience and cost? Blockchain fees, gas can be a killer.
Good point. And that leads straight to the second principle, gas-free transactions.
Gas-free. How? Nothing's really free on a blockchain, is it?
No, not really. It's more accurate to say the gas cost is abstracted away from the end user.
Abstracted, meaning someone else pays.
Essentially, yes. The sources suggest the network operator, maybe the platform or the institution offering the service, covers or subsidizes those gas fees, likely using something called meta-transactions.
Okay.
So for the user, whether it's retail or a bank, the transaction feels instant, frictionless. No confusing pop-ups about gas limits or GUI. It just works. But under the hood, the transaction is still secured by the metal blockchain. The costs are just handled elsewhere.
That's actually huge, because that user experience needs to feel like traditional banking, right? Smooth and predictable.
Absolutely critical for mass adoption, especially institutional adoption. They expect seamless.
Okay, so verified identity, no gas fees for the user. What's the third leg of this compliance stool?
That would be transparent governance. The loan markets themselves, how they operate. It's all secured and, importantly, attested through the loan protocol.
Attested, meaning provable on-chain.
Exactly. Things like collateral ratios, interest rates, how liquidations work. It's not some black box. It's automated, governed by the protocol rules, and everything is viewable, auditable on the blockchain's public ledger. Accountability.
Right, so you put those three together, verified ID, smooth UX via abstracted gas, and transparent auditable rules.
And suddenly, it's not just another crypto lending app. The sources position it as a trusted compliance-first credit rail.
A rail that institutions can actually use without freaking out their compliance departments.
That's the core idea, giving them a way to engage with DeFi markets that fits within their existing regulatory constraints.
Okay, infrastructure makes sense, compliance makes sense, but a market needs fuel, right? It needs liquidity. How does this system actually attract people, attract capital to make it work?
Yeah, that's where the incentives come in, specifically the role of the Luan token.
Right, the ecosystem's own token. How does that play a part?
It's used strategically, according to the sources, to reward both sides of the market, the lenders putting up capital and the borrowers taking out loans.
Okay, so token rewards for participating. What's the goal there?
It's really about engineering a competitive marketplace. By using low-end rewards, they aim for two key things. First, building deepened liquidity pools.
More liquidity means better prices, lower borrowing rates.
Exactly. The rewards essentially pay users to provide that market stability and depth. It bootstraps the liquidity needed for competitive rates.
And the second thing?
Offering attractive yields for the lenders. Let's face it, capital will go where it gets the best return. These yields need to be compelling enough to draw money out of traditional savings accounts or other investments.
So competing directly with banks on yield, but within a compliant framework.
That's the tightrope they're walking. The low-end incentives are the mechanism to make those yields possible, at least initially.
You know, this focus on yield and growth, it brings up that classic finance concept mentioned in the source's compound interest.
Ah, yes, the eighth wonder.
There's that famous quote often attributed to Einstein, though maybe not actually his, but powerful nonetheless. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it.
It's powerful because it really speaks to financial access, doesn't it? Historically, who really benefited most from compounding?
Well, institutions, wealthy individuals with access to the right investment vehicles.
Right. The ability to really aggressively compound growth, reinvesting earnings exponentially, it wasn't always easily accessible for everyone.
So the argument here is that the system changes that.
The argument is that MetalX lending operationalizes compounding at scale and makes it accessible through these compliant DeFi rails. It takes that powerful principle.
Earning interest on your interest.
Exactly. And makes it available to potentially anyone, anywhere who can access the platform, working with a whole range of digital assets. It's democratizing that engine of growth, but within a regulated context.
Okay, let's zoom out again. We've got the 12 assets, the compliance rails, the incentives driving liquidity and yield. How do all these pieces fit together as building blocks for that bigger vision, the global digital banking network, TDBN?
Yeah, it's helpful to think of this initial launch having sort of three functional roles in building towards TDBN.
Okay, layer one.
Layer one is retail access. Pretty straightforward. Using familiar assets like Bitcoin, Ethereum, Stellar, it's the entry point for regular consumers. Get them used to earning yield, maybe borrowing within this compliant ecosystem.
Building the user base. Makes sense. Layer two.
Layer two is what we touched on earlier, the institutional railroads. This is maybe the most strategic layer right now.
The sandbox idea again?
Exactly. It's the safe, regulated practice field for banks and credit unions. They can start experimenting with things they need to figure out. How to issue their own stablecoins, how to manage digital asset custody compliantly, how to provide liquidity themselves.
Learning by doing, but without the regulatory risk of, say, jumping straight into permissionless DeFi.
Precisely. They learn how to operate these new services within the KYC-gated, governed framework.
Okay, so retail access, institutional practice rails. What's the third layer? Where does it lead?
It leads to the settlement hub. This is the long game. The vision is for all this activity, all this liquidity from retail institutions to eventually converge, primarily into the metal dollar, XMD, which is their native stablecoin, and also into those stablecoins issued by the banks and credit unions themselves on their own subnets.
Okay, hang on. Subnets and this settlement layer. The sources mentioned, it's designed to be US-built, ISO 2022 ready. Why is that ISO standard important?
ISO 2022. It's basically the new global language for financial messages. Think of it like upgrading the entire global banking system's communication protocol.
From simple instructions to much richer data in each payment.
Exactly. It allows for way more information to travel with a payment, who sent it, compliance checks, invoice details, all sorts of structured data. This is critical for efficiency, for fighting financial crime, and for things like cross-border payments.
So by building the TDBN settlement layer to use this standard,
they're essentially future-proofing it. They're building a digital dollar system backed by XMD and these bank-issued stablecoins that speaks the same language as modern global finance. It positions U.S. institutions using TDBN to interact seamlessly internationally on a compliant digital rail.
Wow, okay. That connects the dots to a much bigger ambition. Now, the roadmap described goes from these 12 assets today towards potentially infinite assets. What comes next to make that leap?
The next really big wave mentioned is the tokenization of real-world assets, or RWAs.
We hear a lot about RWAs. What specifically are they targeting?
The sources call out treasuries, mortgages, and commodities.
Why those?
Well, think about it. Treasuries are like the bedrock of traditional finance collateral. Putting those on-chain, tokenized, creates incredibly stable, compliant collateral for DeFi.
Okay, that makes sense. Mortgages, though. That's a huge, complex market.
It is. And tokenizing mortgages signals the ambition level here. It's about bringing core parts of traditional structured finance onto the blockchain, making them more transparent, maybe more efficient, potentially more liquid. It moves beyond just crypto-native assets.
So the system evolves from supporting crypto lending to potentially underpinning all sorts of traditional lending, just on new rails.
That seems to be the direction, and that RWA push naturally requires the next piece, further development of institutional stablecoins.
Tailored specifically for banks and fintechs.
Yeah, these aren't just for retail payments. They're designed as settlement tools for institutions operating within TDBN, allowing them to manage liquidity and transact efficiently within that regulated space.
Okay, RWAs, institutional stablecoins. What else is needed for this infinite asset future?
The final piece, and maybe the most transformative, is subnet deployments.
Subnets, we mentioned those. What are they technically? Like mini blockchains?
Kind of. Think of them as custom chains that specific institutions like a bank or a credit union can run for themselves.
So they get their own dedicated blockchain environment.
Exactly. They can set their own rules, maybe issue their own specific tokens, optimize for their specific needs like loan origination or insurance products or asset management. But crucially,
Still connected to the main network.
yes, they still inherit the core security and, importantly, the compliance framework from the main metal blockchain. They get autonomy, but within the secure, regulated TDBN ecosystem.
So a bank could essentially run its own private, customized blockchain operations, but still be part of this larger, compliant network for settlement and security. That sounds pretty revolutionary for banking tech.
It represents a potentially massive shift, giving institutions that kind of control and customization while keeping them tethered to the core compliant infrastructure.
So if we bring it all back,
Yeah.
these first 12 assets on MetalX lending, it's really not just about offering more coins to trade or borrow.
Not at all. It's proof of execution. It's showing they can build and scale these compliant markets, manage identity, handle incentives, attract liquidity, basically demonstrating that the core engine of the digital banking network actually works.
It's the operational foundation for everything else we just discussed.
Precisely, for compliant digital finance built from the ground up.
Okay, so wrapping this up, what does this really mean for the future? For you, listening, thinking about where finance is heading?
Well, it shows a clear pathway, doesn't it?
It does. And it leads to a pretty provocative thought. If this expansion with 12 assets proves the model works for complex, compliant lending, and the roadmap includes tokenizing massive asset classes like mortgages and putting them onto these custom subnets run by banks, well, how fast could we see traditionally regulated banking functions actually move onto these kinds of compliant blockchain networks? Could this become the blueprint for, say, a future digital dollar network? And how quickly might that start challenging the way money moves globally today? That's definitely something to mull over.